Hello, everyone. Thank you for taking the time to join us today as we discuss considerations when buying US real estate for expats in the US. There'll be a Q&A session at the end of the presentation, so please feel free to ask any questions in the Q&A window, which you can access at the foot of your screen, as and when you think of them, and we'll do our best to answer them for you at the end. Just before we dive in, a brief disclaimer. The information presented in this webinar is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific investments or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified professional before implementing any of the strategies discussed. That being done, let's meet our panelists. So, we'll be starting with a segment on financial planning considerations when buying real estate as an expat in the US, presented by Drew Waterbury from Ocean Advisors and Cam Summel from Dunhill Financial. We'll then move on to currency considerations when buying US real estate with Kelly Cutchin from Moneycore. After that, Kevin Gaines, CPA, who specializes in US taxes for expats, will talk about the tax considerations buying US real estate. Nikki Ansons will then talk about the process of buying US real estate. And last but by no means least, Simon Conn, overseas finance specialist, will talk about obtaining finance as an expat in the US. So without further ado, over to Drew and Cam.
Okay, thank you, Hugo. I think I'll get us started here by talking about the role of home ownership in someone's overall financial plan. And obviously, given the time and some of the other considerations, I'm just going to take a high altitude view of all this. But what I want to share with you is that home ownership is a very, very strong indicator of someone's financial stability. Some of the numbers that I've seen recently, I think this came out of the Federal Reserve, that if someone was a homeowner, their net worth was typically 40 times greater than someone who was a renter versus a homeowner, and that was regardless of what your income level was. So, for example, my neighbor and I, just for a round number, let's say we both make $100,000 a year. He owns his home, I'm renting. Chances are very, very good that he's going to have a higher net worth than I'm going to have. Now, obviously, just because you buy a house, that doesn't mean that you automatically increase your net worth by 40 times. The appreciation, the building of equity in your home comes from three factors. The first one is, obviously, you have to make payments on the house. So over time, every payment you're making goes towards building equity in your home, something that a renter is not going to have access to. That's number one. Number two, you're paying with inflated dollars. So a home that you bought maybe 10, 15 years ago, let's say you're locked into a fixed mortgage and you have fixed payments, you're paying back with dollars that are not worth today what they were 10, 15 years ago when you took out that mortgage. Whereas the renter, on the other hand, when they move from location to location, chances are pretty strong the rent's going to go up. As a result of inflation, they're going to have to make those payments with higher dollars. And the third one is, of course, appreciation. What we find is that, yeah, of course, real estate is local. You always want to get in with a good local real estate professional who will guide you to what type of investments, where you should be investing, owning homes. But generically, over time, real estate has been a very, very good investment to make. If you're looking at it as a long-term investment, I think when I think of real estate, I think someone needs to look at owning it for a minimum of 7 years or more before they're really going to see the benefits of those three factors that I just mentioned. This is not as I mentioned, it's not a get rich quick, but it's something that will build your equity. I like to include it in my clients' overall financial plans because it kind of forms an anchor. Real estate's not a very liquid investment, and consequently prices don't move that much. They'll move over time, as I've mentioned, but they don't move that much in the short term. But they're not liquid either. It's, I'm going through a selling my mom's condo right now. We're going 3 months trying to just deal with some of the intricacies of getting an owner and getting into the table and doing the closing. But what it does is it forms a really good anchor for the overall financial plan. I love to include it in my financial plan so I can show people what their overall net worth is, what their balance sheets look like, et cetera, et cetera. And when we look at it from that standpoint that, okay, here's something that's anchoring the portfolio. And by the way, when I'm doing this with clients, typically I see real estate being somewhere in the value of 25 to 40% of their overall net worth. So it's a significant part of their portfolio and a very good anchor. But like I said, it doesn't change value all that often. So what it does allow us to do is have a conversation about how we need to make adjustments to some of the more liquid investments in their portfolio. Think of stocks, bonds, mutual funds, exchange traded funds, things like that, you're not going to move in and out of a house based on what's happening with the economy, but you will want to make changes to your overall liquid investments based on what's happening to the economy and maybe what's happening in your personal life. And with that in mind, I'm going to let Cam talk to you a little bit more about those liquid investments as part of your overall financial plan. So Cam, take it away.
Perfect. Thanks so much for that high-level overview there, Drew. And thank you, Hugo, for putting this great webinar together with a nice panelist that we've got here. So as Drew was mentioning there, oftentimes the liquid part of your investment portfolio can actually be quite complementary to, the overall real estate aspect as well. Real estate naturally offers a lot of diversification as well as some tax breaks, which I know we've got our expert Kevin here to dive down into the tax side of things a little bit more. But really, real estate, in addition to more of the liquid side of the portfolio, really offers that opportunity for longer term wealth creation. And, as Drew was mentioning there, some of the changes that you might want to be looking at when it comes to the actual investments, particularly if you're in the market of looking to buy a home or potentially it's on the horizon, is really looking at some of those risk levels and what's actually in that portfolio, especially if we look at some of the rates and where interest rates have gone in the last, call it 12 to 18 months. We're looking at a rates market that we haven't seen since 2007 and 8. So naturally, although it might make borrowing a little bit more expensive, there's definitely a lot of options out there on the investment side as well to help you build that wealth for that eventual down payment on the real estate. With that, I think I'm going to hand it off to Kelly Cutchin to discuss some of the currency aspects over at MoneyCorp.
Thank you so much. Great job, Drew and Cam. Thank you for taking us through some of that. My name is Kelly Cutchin, and I am here today from MoneyCorp. MoneyCorp's actually a UK-based company who specializes in currency exchange and international payments. We do have offices strategically placed around the globe to assist our clients that are needing to make international payments. I myself am based here in Central Florida, surrounded by expats from all over the world. So I'm going to talk to you briefly about some of the currency exchange considerations when buying real estate, but do know that this information can be utilized for all different reasons for transfers. So for example, if you receive an inheritance, if you are sending children to study abroad, if you're buying a boat or another luxury good, again, as long as you're sending an international payment, this information can be useful to you. But again, today we're going to focus specifically on real estate. So just to throw this out there today, during this presentation on the date of May 17th, we're seeing some exchange rates, and I'll throw those out there. British pound is approximately 1.24 today to the US dollar. The euro, it's rebounded a bit. We're at 1.08. So 1 euro will get you $1.08 currently. And our Canadian dollar, as an example, is currently around 0.74. Those are kind of the key expats that we work with here in Central Florida, but regardless of where you're from, again, the information that I'm going to share with you today is relative. So the first thing to consider when making an international transfer is you want to make sure that you're shopping around to ensure that you're getting the best possible rate of exchange. There's something known as the interbank rate of exchange. That's the rate that big banks are buying and selling millions of dollars of currency at any moment in time. But that's not actually the exchange rate that you or I or anyone for that matter would have access to. However, MoneyCorp does have access to that rate of exchange because annually we convert approximately $60 billion worth of foreign currencies. At least that's what we did last year. So when you contact your bank to facilitate an international transfer, you'll need to be mindful that they're going to take that interbank rate of exchange and they're going to tack on a margin. That margin is somewhere between 3 and oftentimes upwards of 8%. That's a huge margin. At MoneyCorp, we typically work off of a less than 1% margin. So again, we're getting you much closer to that true form of the exchange rate and helping you achieve more bang for your buck, so to speak. So if you are bringing funds in from your home country or sending funds from the US outbound, do make sure that you are comparing the rates and shopping around to ensure you get the best rate of exchange. The next thing to consider is that exchange rates fluctuate constantly. So you're going to want to work with someone who can help you to target a specific exchange rate, perhaps a more favorable rate than what is available for you at this moment in time. So at MoneyCorp, you can tell us your dream exchange rate, and then you can continue to sleep better at night knowing that someone is watching that rate on your behalf. We do even have the ability to lock into an exchange rate for up to 2 years. So if you see the exchange rate reach a favorable level, but you're not quite ready to do a transaction, you can lock into that rate today for a payment that is up to 2 years in the future. It's free to sign up for an account with MoneyCorp. Hugo will be sharing my contact information on the back of this presentation, so feel free to reach out to me or to sign up for an account there directly. You'll immediately be introduced to a personal currency exchange expert. Their job, their role in this is to provide you with exact quotes, expert guidance, and to be a person at the end of the phone who can help guide you through making any of your international payments. With that said, I think I'm going to go ahead and hand my presentation over to Kevin Gaines, who is going to take us through some things to consider with US taxes.
Great. Thank you, Kelly. That was very interesting information on exchange rates, which I see all the time in my practice because I deal with a ton of international tax work. So good stuff. So I want to talk to you guys today about everyone's favorite topic of taxes. I'm going to walk you through the 3 phases of property ownership. So, the first phase being the purchase, then the holding, and then the third phase would be the sale for a huge gain, hopefully, is what happens. So, and I'm going to try to touch on both from a personal residence perspective and then a rental property perspective too, if Hugo allows me to fit that in. So, three levels of taxes that we have here in the States, right? We got federal income tax, state income tax. There's 50 states. So 50 different types of rules. They're very similar, but differences between them all. And then we have the local level taxes within each state. In Florida, where I'm at, we have the different counties that have different types of taxes that apply, and there's numerous counties as well. So a lot of different rules that come into play. So we're going to cover just a general view today. So talking about the purchase of a personal residence, the taxes that will apply to that, you as a buyer, pretty much none. There's a transfer tax that applies, but usually the seller's paying that as part of their closing costs, and that's assessed at that local county level. And it's based on the sales price of the property. Now, you may see on the closing statement a proration of property taxes, and that's just the annual taxes getting prorated between the buyer and seller. So the purchase, you're really not paying any taxes there. But then on the holding of the property on an annual basis, you're going to have your property tax. So that's basically going to be an assessed value by the local property appraiser, and then they assess a certain percentage tax rate. Every county is going to have a different rate. So it really matters what county your property is located in. From an income tax perspective on an annual basis, mortgage interest, if you have a mortgage, and your property taxes are basically the only deductions you're going to get if you even itemize. Insurance, improvements, repairs, things like that, none of that's deductible when it's just your personal residence. And then your principal payments on your mortgage are not deductible either. That's usually a a common misunderstanding of those rules there. So that's the holding. So now let's talk about the sale. This is where it gets fun. This is where the income tax comes into play. So hopefully you're selling it for a gain, right? So the gain is going to be sales price minus your closing costs on the sale, your realtor commissions, and some other types of costs that are built in there. And then what you paid for the property, right? Your cost of the property is called a cost basis. You deduct all that from the sales price. You also get to deduct if you made any major improvements, you know, that kitchen remodel, the bathroom remodel, those types of things, not, you know, basic repairs, but major improvements. So if that ends up being a gain, then you're going to pay tax at the federal level and the state level if the state has a personal income tax. In the state of Florida, we don't have a personal income tax, so we don't pay Florida income tax on our income. With that being said, if it's been your personal residence for more than 2 years, you get this nifty little exclusion from your taxes. So if you're married filings jointly, you can exclude up to $500,000 of the gain on the sale of your primary residence. And if you're another type of filer, single, married filing separately, you can exclude up to $250,000. So this is a big deal here in the US, because the last thing you want to do when you're selling your home, a lot of times you're selling your home to then upgrade to a bigger home, or the downsize, and you might need some of those funds for the down payment. You don't want to have to pay taxes on that as well. So that's a great benefit. Now, if you do have to pay taxes because either you don't qualify or your gain is too large, which is pretty common these days with the property values, how great they've gone up lately, you're going to pay tax at long-term capital gain rates, assuming you've held it for more than a year. So those rates are going to be anything from 0%, 15%, or 20%, depending on where your overall income falls for that year. Another thing to consider when you're going to sell your home, a lot of times you kind of know a little bit in advance, right? You just don't wake up one day and say, I'm selling my house today. That's a good time to talk to your tax advisor about any planning you can do a year out. If you know 2 years out, you're thinking about moving at some point, you can do some planning to reduce that tax burden, if there will be a tax burden on that at all. So that's the 3 phases of personal residence ownership. And I'll just touch briefly if it's a rental property, because that's pretty popular too here in the States. Purchase, no difference, same thing, really no taxes apply. The actual holding of it, the rental piece, you're going to have to pay tax on that if there's a net profit. You know, obviously the rent you collect is income. You get to deduct from it basically all the expenses related to activity: mortgage interest, property tax, insurance, repairs and maintenance, property management fees. And then you get to deduct a portion of the cost of the property, what you pay for it, about 3.5% a year. It's called depreciation. If there's income, you pay tax. If there's a loss overall, you may get to deduct it and offset your other income, wages, other type of investment income. On the sale of the property, similar to your personal residence, how you calculate the gain, the difference is that depreciation increases your gain as well. So you could end up with a larger gain than if it was just your personal residence. Tax-wise, still long-term capital gain rates, except for the depreciation portion, you're going to pay a little bit higher tax rate on that for this recapture that has to be done. Unfortunately, you don't get to exclude any of the gain because it's not your personal residence. But the good news is you hopefully made some good money on that. And then you could turn it over to Drew and Cam to invest that money for you, all that profits that you had. But that's pretty much it in a nutshell. Quick disclaimer, this isn't specific tax advice for anyone out there. It's general information. Make sure you talk to your tax advisor about your specific facts, because any change in the circumstances can make a difference. So now I'm going to turn over to Nikki. She's going to talk about the process of buying real estate here in the US.
Nikki, you're muted.
Thanks, Kevin. Sorry, everyone. So I'm Nikki Ansons. I'm here at Coldwell Banker here in Central Florida. I work closely with Kelly and people like that to help our clients transfer their funds. One of the main differences as a real estate agent, as you can hear, I'm from the UK myself, I'm from London. One of the main differences is the time that it takes to buy and sell real estate in the US, particularly here in Florida. So we're used to very lengthy processes in England where they can take 3 months, 6 months. People have horrible stories about long chains and all of that kind of thing. We don't very often have contingent sales or chains here. That's fairly uncommon. So one of the things that most expats are actually shocked about is actually the speed of our processes. So one of the main differences that you will find is here in the US, as we speak, this may well change with current goings on, but as we speak, a buyer will have their own agent and the seller will also have an independent agent. And most of the work that is often done by our solicitors and things in the UK are actually done by the two real estate brokerages and either a title attorney or a title company here. So that may account for some of the speed because, you know, people are working on something all the time. It's not, you know, left at 4 o'clock and people start again the next day. We work well into the evenings. And it's very personal. So here you would have a buyer's agent who will work with you, get to know you, identify the needs around the property, be it location, commuting, children's schools, your lifestyle, all of those kinds of things, and help you to zoom in and narrow in on areas and neighborhoods that suit you, meet your requirements. And then it's a very kind of structured approach to finding you that property, writing that offer, and they will stay with you through the whole process. So that's really one of the major differences between the UK and the US. The other thing that you will find is that things like inspections and appraisals, it's a bit like the Grand National. That's what I tell my UK clients. You have to jump a couple of hedges, and one of them being inspection, where your home is inspected, all the major systems by a licensed home inspector, so that you're happy that it's in the right kind of shape. Which is very similar to our survey at home, you know, the way that we do it in the UK. And then you will also have, if you are purchasing with a mortgage, you will have a bank appraisal, which is very similar to the same thing, a valuation done by your mortgage lender in the United Kingdom to make sure that the contract price and the value of the property meets and you're all good and you can move forward. So generally it's speed, and here you have a dedicated representative as a buyer, as opposed to seeing homes online, approaching real estate offices either online or in the high street to go see a property. Here you have someone really that advocates for you as a buyer. Similarly, when you come to sell the home, you would have a listing agent who will market your home and do all of the work that is necessary to safely convey a property over to the new buyers. One of the main things that people ask mostly about here is things like title insurance. And a lot of UK buyers ask me, you know, Nikki, what is that? What does it mean? It's very similar to the kind of indemnities that we have in the United Kingdom, so that we safely transfer deeds over to the next buyer to make sure that there's no troublesome issues for you as a buyer once you close or you sell a property. So that's kind of the main differences here in the US compared to what we would see in the UK. So with that being said, you know, talking about mortgages, I'm going to pass on to our colleague Simon, and he's going to talk to you a little bit about the process of obtaining a mortgage for your US property.
Hi, everybody. Yeah, my name's Simon. I've been in the industry now over 40 years, involved with the overseas mortgage market. I'm based in the UK, but I work very closely with a US regulated US broker who covers most of the main states. Primarily, the main mortgage inquiries we get at the moment is for people moving into the US, where you can get up to 60 to 65% loan to value. In most states, 65 to 70% loan to value if you buying in Florida. Now, if you're living in the US and you're originally a non-US national and you've moved to the States, then what you can borrow will all depend on what your status is. If you've only just recently arrived with a valid work visa, or you've been there for 2 years and you've got at least 2 years worth of tax returns and credit history, then it may be possible. And this is all with all this, it's all subject to your overall financial profile and the valuation of the property, the purchase price of the property, and the amount you're borrowing. But you could possibly be looking up to 80% loan to value. Again, the interest rates will vary depending on how much tax returns you've got, what your visa status is, and how long you've been in the States. The other thing to bear in mind, of course, is that you may not just be, those terms are based on people being employed. If you're self-employed, i.e. you've come over here and you're now running a business, they will look at it as with only 1 year's accounts and tax returns, but you still need to have at least 12 months credit history. The more you can show with credit history, credit cards, the better, having bank statements. And then again, it will depend on what type of visa you're holding. Again, there are lots of different types of visas. There's E2, L1, and we can go through all that once we've heard from you and explain to you the different type. If you're thinking of moving to the States and looking to buy a business, it's better to apply really before you come over and before you buy the business, and do it as a holiday home and retirement home, and then look at getting the business at a later stage that may be better for you. And then you can convert after 2 years of being over here into a conventional mortgage, again, building up a tax record and credits in the States. But it all comes down to really how long you've been there, what your visa status is, and how many years you've got of credit history and tax returns in the States. The more, the better. It's probably is the answer there. And again, it comes back down to your financial profile, purchase price, location of property, amount you're borrowing. So that's it in a quick summary. But of course, everybody's case is going to be different. And what we try and do is that we get a questionnaire filled in to analyze and then deal with it all on a case-by-case basis.
Thank you very much, Simon, and thank you, everyone. Very quick, brief overview of lots of different aspects of buying real estate in the US. And I think, yeah, it's makes perfect sense. If you're looking to buy real estate in the US, you need to talk to different and bring together a team, very like the panelists today, to make sure you have your tax situation, you get the best rates on currency transfer, on a loan if you need one, and a good realtor who's going to help you put everything in place, as well as the overall kind of financial planning position for you and whether it makes sense and how to approach it. So that's great. We've just got a couple of questions, a couple of tax questions. Inevitably, tax always, as you said, Kevin, everyone's favorite subject. So one question is, what are there tax implications if you're transferring money from Europe, say from the UK, for example, to the US to buy real estate? Is there a tax implication potentially from making that transfer, or reporting implication?
Well, that could lead down about 5,000 different roads to answer that question. But if it's literally from a bank account in the UK or wherever to the US, you're not going to have any tax implications to doing that transfer. Now, if you're selling investments, if you're selling something from overseas, if you're making a transfer from the bank account of the foreign corporation that you have control over, those different things muddy the water very quickly and can become problematic. But the simple vanilla, transferring from your personal foreign bank account to your US account of just cash, it's a non-issue.
Thank you. And another tax question relating to rental income. So US tax is payable on rental income if you have real estate in the US. Potentially, are there double taxation issues there if you're a citizen from another country?
Great question. So I can't really speak for the foreign tax implications, but from a US perspective, if you're a US taxpayer, you're going to report, you have to report that you're going to pay the tax. The US is going to tax that. Now, I don't know, whatever country that you're a citizen of that you have to also report that income on, presumably you could get a credit for the US tax that you're paying on the US real estate, because that's how it works in the US. If I owned a rental property in Paris and I'm paying tax in France, when I report in the US, I'm going to report that income, tax is calculated, but I get a credit to reduce the US tax on that same income because I've already paid some tax, so I'm not double taxed. So, but if it's US property, you would want to speak to your advisor, your tax advisor in that foreign country to see if you get a credit or how that's going to be handled.
Of course, the US tax system's a bit different because it taxes on citizenship, whereas I think I'm right in saying most countries, if you're resident in the US, you may not have a foreign tax or non-US tax.
There's a couple countries that are doing a worldwide taxation as well. So I'd be interested what country that they're from and if it is worldwide or not. But yeah, that's a foreign jurisdiction question from that perspective.
Okay, well, we don't have any other questions. So in record time, I'd like to thank everyone for taking the time, both our audience and our panelists. And I will email our audience tomorrow with the panelists' contact details if you have follow-up questions. And it is important, if you are buying real estate, to seek your own advice, as with all financial planning and tax issues. So with that, thank you very much to our panel and to our audience, and wish you all a good morning, afternoon, or evening, depending where you are.